Welcome back to the Deep Dive. Today, we are diving deep into the unaudited financial results for PTC India Financial Services, which we'll just call PFS.
Yeah,
We're looking at their second quarter and half-year results, the ones ending September 30, 2025.
right. And it's quite a stack of sources. We've got the financials themselves, the investor deck, the press release, and they paint a really interesting picture, don't they? An infrastructure finance company, an IFC, caught between like two really big contrasting forces.
Absolutely, yeah. Our mission here is basically to figure out the real story, the long-term momentum of PFS, because that initial hook, you just can't avoid it. You see these huge profit after-tax numbers.
The explosive growth.
Exactly, driven by what looks, on the surface, like this miraculous cleanup of their loan book. But then right alongside that, you've got these, well, unexpected shifts happening at the board level.
Right, the governance piece.
So we need to figure out, is this company really defined by this suddenly cleaner balance sheet, or is there something more to this boardroom story?
Precisely. And I think if you want the shortcut to understanding PFS right now, you have to start where the biggest change happened. That's the asset quality. It's dramatic.
Okay, let's unpack that primary aha moment, because the speed is, well, it's kind of stunning. We're talking about a really rapid, almost surgical cleanup of the non-performing assets, the NPAs. This isn't just, trimming around the edges. It feels like a major de-risking effort, something that must have been building for a while.
Oh, absolutely. It's a phenomenal achievement in de-risking. And the numbers, the year-over-year metrics, they really tell the story. Let's look at the riskiest stuff first. Gross Stage 3 assets. For anyone listening who isn't familiar, that's the measure of their highest risk non-performing loans, the real dead weight.
Okay, and that number gets slashed by how much exactly?
75%
Yeah.
year on year. They were sitting on a pretty hefty euro 764 crores in Q2 of FY25 now. They're down to just 193 crores in Q2 FY26. I mean, pulling off a 75% reduction in that time frame, that says a lot about management focus and, well, successful resolution.
That is a massive amount of old baggage just gone. But what about the net picture? After they account for their provisions, their safety net.
Right, the net stage 3 assets. That number, what's left after provisions, dropped even more sharply, down a staggering 83% year on year. It went from 283 crores down to just 47 crores, 47. And what's really important here is that while they were shedding all this risk, they actually improved their provision coverage ratio, the PCR, for the stressed assets that remain, pushed it up to 76% from 63% last year.
Okay, so hold on. They didn't just clean house, they also built higher walls around the smaller amount of bad debt that's left. That sounds like genuine stability improvement.
It really does.
All
And
right.
operationally, the details kind of back this up. They point to renewed discipline. The really crucial bit here is that management reported 0 new loan slippages in the whole second quarter. None. And maybe even more encouraging, all the loan accounts PFS has actually disbursed since way back in fiscal year 2018. They're all currently classified as standard.
Wow, okay. That's a very strong signal, isn't it? Suggests confidence in their newer business, their underwriting.
Exactly. Renewed underwriting discipline.
So that successful de-risking, it naturally leads us to the money side, the financials. They've cleared out the deadwood, so let's look at how that actually hit the bottom line. The cash flow, the profit figures for the quarter, those profit after tax, the PAT figures, they look great, but they're obviously tied pretty tightly to finally sorting out these old legacy problems.
Absolutely. Intrinsically linked. The PAT for Q2 FY26, it grew 86% year on year, landed at 88.14 crores. And for the full first half, H1 FY26, the PAT reached 224.77 crores. But, and this is key, you have to remember this isn't just shiny new business driving this.
Yeah.
It's largely the result of resolving like 4 major long-standing headaches almost at the same time.
Right, like clearing a massive traffic jam that's been there for years.
Exactly. It's almost like 4 historical jams just vanished. It feels like a, once-in-a-cycle kind of event for the balance sheet.
Okay, let's quickly run through those specific resolutions for everyone listening. What were those 4 key things, cash coming in, accounting benefits, that drove this profit surge?
Okay, first up, they successfully resolved the NPA debt of Miss Minto Power Infra Private Limited, or VIPL. That yielded a gross transaction value of 115.61 crores. And crucially, it was fully received. Cash in the door. Clean break.
Okay, one down. And the second was another one that had been dragging on.
Yes, another long-term resolution finally bearing fruit. They received the entire principal amount, 125 crores, from Ms. NSL Nagapatnam Power and Infratech Limited. This came after a resolution plan approved a few months earlier. So again, essential principal cash hitting the books. Successful restructuring payoff.
Got it. Then there's the ILNFS Tamil Nadu power situation, ITPCL. That one's a bit more nuanced. It was upgraded.
Yeah, that's an important regulatory update. The ITBCL loan account got upgraded to the standard category in Q2 FY26. Good news. But, and this shows their ongoing prudence, they are still maintaining a 100% provision against what they call the unsustainable loan portion. That's about 74.77 crores. So they took the upgrade on paper, but internally, they're staying super cautious, keeping those reserves high, just in case.
Huh. That feels like really responsible balance sheet management. Take the win, but keep the safety net.
Okay. And the last driver, that was more of an accounting benefit from an old investment.
Correct. This ties back to the dissolution of MISI East Coast Energy Private Limited, ECEPL. PFS had claimed a big business loss back when their equity stake there was canceled out. So now in these Q2 results, they've recognized a resulting tax benefit, 39.49 crore, booked under earlier year taxes. So yeah, you combine actual cash recoveries, major loan upgrades, and then this favorable tax accounting. And boom, that's how you get that dramatic profit lift we saw this half year. Okay, that gives us fantastic context for how they clean up the past. Super helpful. But look, an infrastructure finance company, they don't make money just looking backwards, right? Let's shift focus. Segment 3, the forward-looking strategy. Where is this, newly solvent, cleaned up IFC actually putting its fresh capital? Where's the focus now?
Right. And this is where you see the real pivot happening. Structurally, the results show this massive restart of fresh business activity. They're aggressively seeding new projects, hopefully high-quality ones. Loan sanctions in Q2 FY26 hit 1,048 crores.
Wow. Okay, that number really jumps off the page. 1,048 crores.
It really does. Especially when you consider that's the highest sanction figure they've reported in 10 quarters. 10.
Yeah.
And compare that to Q2 last year. It was NIL. 0 sanctions. Disbursements also followed strongly, 326 crores, again, compared to NIL last year. The engine isn't just starting. It feels like it's fully restarted.
Okay, but what's the strategy behind these new loans? Are they just going back to the same old well, the same customers that maybe caused some of the problems we just discussed?
Good question. And the answer is quite the opposite. And this, I think, is the most critical strategic move you can see in their presentation. They are very intentionally pivoting away from being heavily reliant on state utilities. That model historically created exposure to political risks, regulatory delays, payment issues. They're actively de-risking the future portfolio now. And to really underline this commitment, 100% every single rupee of their Q2 FY26 disbursements went to private corporates.
100% in one quarter. That's a very deliberate signal. But okay, let me push back slightly. Given the history of infrastructure, sometimes private sector projects have their own volatility, right? Is there any risk they're just swapping one kind of concentration state utilities for another?
That's the key question. You're right. And the answer, or their intended answer, seems to lie in which private sectors they're targeting. Their stated goal is clear. Get that state utility exposure down to just a third of the total loan book over the medium term. And yeah, over 90% of fresh proposals are coming from the private side now, but it's not like they're just financing, old school high-risk thermal power plants again.
So what are they targeting then? What specific segments are getting this new investment?
They're heavily emphasizing sustainable infrastructure. Think projects with clear regulatory support, lower long-term fuel risk, that sort of thing. The investor deck actually details these new kind of future-focused segments, things like electric vehicle mobility infrastructure.
Ah, okay. EV charging, battery swapping.
Exactly. Also water treatment projects, compressed biogas, CBG, bioethanol production facilities, and even energy storage systems, battery storage. They seem to be hunting for these more specialized, maybe lower volatility infrastructure assets within the private space.
Okay, that makes sense. But pulling off this kind of transition, it requires real institutional strength, right? Financial muscle. How does this pivot look from that angle? What are the key ratios telling us about their ability to actually absorb risk as they make this shift?
Yeah, good point. And the financial strength metrics look, well, almost universally reassuring right now. Their capital adequacy ratio, CAR, is really high. Robustly high at 62.63%. For an IFC, that is a huge cushion. It basically means they have an enormous amount of capital relative to their risk-weighted assets. That gives them a lot of freedom, a lot of firepower to be aggressive and strategic in redeploying into these new private sectors.
And their debt levels, their leverage position is cleaner too, I assume.
Significantly cleaner, yeah. Their debt-equity ratio improved dramatically. It fell to 0.76.
Mm-hmm.
Just compare that to 1.27 only a year ago.
Mm-hmm.
So you've got this higher capital cushion combined with lower leverage. It really means PFS is operating from a position of pretty profound financial strength as it tries to execute this big strategic pivot.
Okay. Financial strength looks good, strategy seems clear. But we can't really talk about stability and confidence without, addressing the elephant in the room. Segment 4. That recent, slightly surprising corporate stability news. That sudden shakeup at the board level, which happened literally right before these otherwise fantastic results came out.
Yeah, this is the necessary context, isn't it? You have to acknowledge it. The sources confirm it. The sudden resignation of 3 independent directors happened on September 26, 2025. And the timing, yeah, it definitely raised some eyebrows,
Yeah.
especially since their terms were supposed to run until mid-November 2025. For an IFC, independent directors play a crucial oversight role. Losing 3 at once suddenly like that, it carries weight. It gets noticed.
Right. What explanation or context did management actually provide for these sudden exits?
Well, management was pretty clear in their disclosures about it. They noted they were surprised by the suddenness. And they specifically stated that no prior concerns about the company's operations or governance had been raised by these outgoing directors. So, the narrative they're putting forward suggests the reasons might be external, maybe personal to the directors. But regardless of the reason, the market needs reassurance when a vacuum like that appears.
Absolutely. So what did management do immediately to plug that gap, to try and restore confidence?
They clearly prioritized rapid stability and bringing in high-caliber replacements. Very quickly, they appointed Miss Minnie Ipe. She's the former managing director of LIC, Life Insurance Corporation of India.
Oh, wow. Okay.
Yeah, that's a very calculated, strong appointment.
Yeah.
Bringing in someone with that kind of deep institutional pedigree, experience from one of India's absolute largest financial institutions, that sends a signal. And they also noted that other appointments are already in progress to make sure the board remains, fully functional and compliant.
Yeah, bringing in a former LICMD right after this big balance sheet cleanup, that definitely signals a strong commitment to premium governance standards, doesn't it? Suggests they understand that financial stability has to go hand in hand with institutional credibility?
Absolutely.
Yeah.
It feels like a necessary move to counter any sort of lingering questions the market might have about boardroom harmony, especially after, let's face it, some turbulence over the past year or so.
Okay. And just finally, to close the loop on the due diligence side, what about the security cover for their non-convertible debentures, their NCDs? That's often a key check for institutions looking at IFCs.
Yep, that box is ticked too. The information's confirmed, and it looks reassuring. The auditor provided the certification that the required security cover for the NCDs is in place. Specifically, the security coverage ratio, calculated on book value, is verified to be more than 1.00 times the outstanding debt. In fact, for some specific high-profile bonds like their Infrabond Series 2, Option 3 and 4, the ratio was confirmed to be a pretty robust 3.35 times. So yeah, in terms of compliant, secured debt obligations, all the checks seem green there.
Okay, that brings us pretty much to the end of this deep dive. So to quickly summarize the key takeaway for you listening, PFS has, successfully navigated what looks like a pretty brutal cleanup phase. They've chopped down their highest risk assets, gross stage 3, by 75% year over year, and that was driven by finally resolving several long-standing problematic debt accounts. At the same time, they've hit the accelerator on a strategic pivot towards, hopefully, high-quality, sustainable private corporate lending. And we see that in the Q2 sanctions figure, highest in 10 quarters.
Yeah, the story really is one of dual progress, isn't it? Settling the old accounts while aggressively seeding these new, hopefully better quality business lines. However, and there's always a however, isn't there? If we connect this back to the bigger picture, this cleanup, as necessary as it was, it came at a cost. Specifically, a cost to the overall size of their balance sheet, their loan book. Remember, an IFC makes money by having a large loan asset base out there earning interest.
Right. And that loan asset base has shrunk quite dramatically. You pointed out it's down from about 5,250 cores last year to just under 3,700 cores this quarter, ending 3,697 cores.
Exactly. And that shrinking, even if it's for good reasons cleaning up bad debt, it directly reduces the interest income they can earn. You see this in the top line. Total income for the first half of the year, H1 FY26, it still shows a dip. is 274.10 crores compared to euro 324.65 crores in H1 FY25. So that phenomenal PAT, the profit, that's largely an accounting win from the cleanup effort. But the core revenue line, the income from lending, that's actually shrinking right now.
Okay, so this really raises the critical balancing act for you to consider as you track PFS going forward. The core tension seems to be this. The current profit surge is mostly driven by settling the past, by these resolutions. But can the new momentum, the accelerated sanctions and disbursements into the private sector, can that build up fast enough? Fast enough to overcome the lower interest income they're getting from this necessarily smaller loan book? Can it deliver sustained, growing, long-term revenue?
Yeah, that's the race, isn't it? This pivot is essentially a race against that shrinking revenue base. They have to replace those old, low-quality, high-risk assets with new, high-quality, hopefully decent yield private assets. And they need to do it quickly, swiftly enough to first stabilize and then start growing that crucial loan asset base again. So watching the stabilization and then hopefully the subsequent growth of that total loan book number, that's probably the single key indicator to watch over the next year or so.
A great challenge and a key metric to leave you with. Thanks for joining us for this deep dive into PFS.
Yeah, good discussion. We'll catch you next time.